Anyone can make their mortgage tax deductible, even if it's your own home. I'm going to unpack a strategy that the government and the ATO probably don't want you to know. Now, this is not financial advice. This is just a tactic that you can use to save a serious amount of tax. The average mortgage in New South Wales is $711,000, which based on average mortgage interest rates today would mean that you're paying around $42,000 a year in interest costs. Now, if you earn more than $45,000 a year and therefore your marginal tax rate is 34.5%, if you're able to claim that $42,000 as tax deductions instead of non-deductible interest payments, that would give you back $14,700 every single year in your bank account. Not just deductions, it's 42K deductions, $14,000 extra in your bank account every year. So how do we make that happen? Now, when you make mortgage payments and pay interest costs on your own home, that is not tax deductible because the purpose of that debt is to own your own home. That's not for investment purposes, and therefore that debt is not tax deductible, but it can be converted into tax deductible debt if you know how to tackle things. Debt recycling is a strategy that over time allows you to convert your non-tax deductible home loan debt into tax deductible investment debt. How this strategy works is that you make extra payments into your non-tax deductible home loan debt, and at the same time you draw an equivalent amount out and use it for the purposes of investments. When you do that, it magically converts the debt into deductible debt, and over time you reduce your non-deductible debt and increase your tax deductible debt while your overall debt levels stay the same. This is why they call it debt recycling. Practically, what needs to happen is that you make payments directly into your non-tax deductible debt, draw those funds either from your existing facility or from a special purpose debt recycling loan, and there's a couple of these around, and then you use that money to invest. Normally that is through a share portfolio. It's the simplest way of doing that, plus you can do it in any value depending on what size the payments in and out actually are. The magic happens here when you take the money out for the purposes of investing, because that converts your debt into investment debt, and that's what gives you the tax deduction. This strategy can create some serious tax savings, but at the same time, because you're actually investing the money into a share portfolio which has a higher long-term return than the interest costs on your mortgage, it means that your share portfolio should be growing faster than what your mortgage debt actually is. So it has the investment benefit alongside the tax benefit. This is one of my favorite wealth creation strategies, but the rules are a little complex and confusing, and you may need to make sure that you've got the right product set in place to take full advantage. Make sure you get some good advice, get your I's dotted and your T's crossed, but it can be seriously powerful to help you get ahead.